Welcome to Investors Insights. Our topic today is money, money, money. We picked that topic because we're hearing about money. We think money is going to be the topic of the week. And as we go forward through this year, as the Fed looks to raise rates, as well as all the other economic news is coming out, we thought it was appropriate to say money, money, money. So with that, I am going to introduce my distinguished colleagues who brought some great information to the table today in our early morning meeting. Trey Booth, Adam Van Zant, and Ty Miller. Gentlemen, always great to get with you, and I always look forward to our Monday morning meetings and debate and discussion. So with that, Trey, big week. The Fed is going to be making some announcements here. Probably going to be seeing some interest rate hikes. Talk about us, money, money, money.
Yeah, absolutely. This is Fed week. The Fed is fully expected to raise interest rates when they meet on Tuesday and Wednesday. They'll announce late Wednesday. There was some concern last week. We got a negative GDP print, which came in well below expectations. We were expecting growth, maybe not robust growth, but still positive growth. And when you saw the negative GDP print, people expected maybe the Fed won't have to be as aggressive because the economy is slowing, and that may reduce inflation. The trouble is that the negative GDP print, when you look under the hood, really wasn't that bad. Consumer spending was positive. Corporate spending was positive. So if you have a positive consumer or positive corporate America, how could you have a negative GDP? Well, it was trade. Actually, our net trade withdrew 3.2 percentage points from GDP. That means we bought more than we sold quarter over quarter, year over year by a large amount. And that's more of an indication of weakness abroad. That kind of shows that the U.S. is very strong. And that makes sense. You look, Europe is very weak right now with what's going on with Russia, Ukraine. China is in the middle of rolling lockdowns. So that makes sense that really the U.S. economy, if you look at the U.S. consumer, again, the U.S. corporation, those are very strong. It was more of our net trade was what drove down GDP. And so the Fed may look at that as a negative GDP quarter as more of an anomaly and still be able to be hawkish. And that's what the markets are predicting, that the Fed will be very aggressive, raising rates by at least 50 basis points on their meeting this week. That'll be the first 50 basis point hike in over 20 years. So something doesn't happen very often. And the reason they'll be doing that is to try and slow the economy down, slow inflation down. That's the Fed's big focus. At the end of the week, we'll get the jobs data. That'll be another huge point. But the Fed is what the markets are watching this week very closely.
Well, and Trey, you brought up a really good point in previous meetings also that the news media is going to be speculating how many interest rate hikes are they going to do. And they can get really extreme on that. Just elaborate, you feel like that the Fed will pace itself. They're going to be looking at that data as the year progresses, correct?
That'll be the big news out of the Fed this week. Everyone kind of expects 50 basis points. It's what they imply for their next meetings, which are in June and July. And the market's currently expecting another 50 basis points in June. But there's a large spread for what's expected in June. So how the Fed signals going forward. And the Fed has been the biggest driver of the inflation by generating a large amount of new funds and new money during the crisis to prevent the crisis from getting worse. We're through the crisis, so now the Fed is in the policy of seeing how they can remove that excess stimulus and how quickly. And so, where the Fed guides going forward is really what the market's looking at, not necessarily what they're doing today, but how dogmatic they'll be going forward to their preset plans. Because the market's pricing in 10 rate hikes this year. That would be a very aggressive Federal Reserve, especially
very much so.
Even though GDP wasn't really negative. If you look under the hood, definitely not a robust GDP report last week. So we're balancing the real economy versus the financial economy versus what the Fed is looking at. There's a lot of plates or balls in the air right now that we're really trying to balance.
Yeah, and let me say this. People get nervous during volatility, but there can be great opportunities during volatility, and we're going to continue to keep you updated as our viewers and as our clients with this volatility and where we see opportunity and how we navigate through it. And we're not only going to do it through these vlogs, but also from the standpoint of our social media in terms of LinkedIn, Twitter, our podcast, Facebook. So we're using multiple ways to communicate. But the news media is always looking for a great story. And, there can be emotion and hype that goes into that. And we want each of our viewers to understand we're watching their portfolios in relation to the financial blueprints and basing it on fact as we make these decisions. Ty, you're one of the main reasons we chose money, 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 money. I think I'm saying money way too many times, but it's because of money supply. And you brought up some great data in regards to that. So talk about money supply in terms that everybody watching our vlog can appreciate and understand in relation to their portfolio.
Yeah, so we met with one of our leading research partners this past week, and one area they said focus on that doesn't get a lot of notoriety is the money supply report. So that came out on Tuesday, and kind of how you can think about this is, let's say our economy had $10 in it and it had 10 apples, so each apple's worth $1. Well, if all of a sudden they raise the money supply by 50%, we have $15 there, well, only 10 apples, every apple is going to be $1.50. That's kind of an inflation story with money supply. So that's something we kind of looked at. And since COVID, 40% of the dollars in circulation currently have been since COVID. That's a huge increase. And that's one of the reasons we're now seeing some inflation. But luckily, we got the report on Tuesday and we're actually seeing a dip. So we peaked in January and we're coming back down on money supply. So they're starting to take some money back out of the economy, which is good news. And then in this other chart, as you can see, as I mentioned, is typically a leading indicator of inflation. So money supply growth really peaked in 2021, at the beginning here of 2022, and it's been like a 6-month lag for inflation. So now inflation's starting to pick up. Now that we're drawing down, hopefully in the next few months, we can start seeing some peak inflation that everyone keeps mentioning. But time will tell.
Let me say this. That's why I love our meetings. We some people laugh that we really nerd out, but that's great information and behind the scenes data that the general public's not hearing in the news. And so, yeah, we're looking forward to you keeping us updated on that. And that's a key indicator I think we need to stay focused on. And with that, Adam, you're getting calls and emails from clients. They really enjoy you talking about the indices and support and resistance levels. Give us an update here on the S&P 500 and any other insight that you've got.
Absolutely. We saw volatility really ramp up last week in the overall markets, with all 11 sectors on Friday being down more than 2%. So the S&P came in on a close on Friday at 4,131. That gives us a new short-term resistance level of 4,170, a new support level of 4,100. Also, we saw a unique event kind of take place with the S&P 100-day and 200-day moving average come in both at 4,492. So, Trey talked a lot about GDP along with the Fed. Ty kind of covered money supply. These are economic headlines that we're really looking at to see as we're testing the intermediate and long-term support and resistance levels. So those are going to be some big headlines to look at this week and continue to follow these patterns.
No, you're absolutely right on that. And so here at Five Pine Partners, we definitely use the fundamental information, the market data, but we're also following those technicals that give us indications on where things may go. So with that, folks, we're going to keep you updated. We strive every day here at Five Pine Partners to make our clients' lives better, richer, fuller. And needless to say, the month of May's got some announcements coming forward, and we're going to give you the analysis and how it relates to your portfolio. So make sure that you stay focused on these vlogs and take a few minutes out of your schedule to see the information that we put together. We thank you for believing in us, and we hope you have a great first week of May. Thanks.